Hello and good afternoon, everybody. Thank you for attending this webinar. My name is Jared with Next Generation Trust Services. My company handles self-directed retirement plans. With me today, very exciting, Global Assets Group and the representative, Denise Yagodzinski. She's going to be discussing real estate investments, real estate markets, trends in the market, real estate cycles, so much planned for you. Within a self-directed IRA, you certainly can invest in real estate. Obviously, that's the number one thing that people are investing with these days. And so basically, I'm going to go over a little bit about the self-directed retirement plan portion, and she's going to go over about the real estate investment portion. If you ever have a question, you can chat in the chat box or in the question and answer box. Either one will work. They will come directly to me. I will take them at the end of the presentation, at the end of my presentation, and Denise will also leave time at the end of her presentation to take any of your questions. So we're going to start off with, what is a self-directed IRA? A self-directed IRA is a retirement account that allows you to invest in non-traditional assets. Usually these assets are something that the client already knows and completely understands. So typically with a retirement plan, you are investing in stocks, bonds, mutual funds. This is non-traditional stuff. So if you are a real estate agent, if you are a real estate investor, why would you not be investing in real estate with your IRA funds? Now, what Next Generation is we are the administrator. We do the administrative work and the IRS reporting for any assets within your IRA. We're not a bank. We're not a financial planning service. Basically, we can give a yes or no as to whether something is allowable to be invested in within a self-directed IRA. We can't endorse, we can't recommend, sell any products. All we do is education. Yes, you can invest in it. No, you cannot invest in this using an IRA. There are several types of plans that can be self-directed. The first one is a traditional IRA. So that's tax-deferred investing. It's a tax write-off in this current tax year. However, you will be paying taxes presumably when you're at a lower income level, when you reach retirement age. A Roth IRA is tax-free investing. However, you are paying taxes in this current tax year, but any assets and the earnings that you receive on those assets are 100% completely tax-free. A SEP IRA is for self-employed individuals. This is the same type of plan as a traditional IRA, which is tax-deferred. However, the contribution limits are much, much higher on a self-employed IRA as opposed to a traditional IRA, where with a traditional IRA in this current tax year, you're allowed to contribute $5,000. With a self-employed IRA, it's up to $49,000 that you can contribute. A simple IRA is for small businesses. You can have employer plans, such as a 401k plan, be self-directed. Also, you can create a 401k plan and have a portion of it that is self-directed. We have several people that are flipping houses out of their employer 401k plan, and it's working out very well for them. Some other options for plans that are not retirement related are the Coverdell, which is for childhood education, and the health savings account, which you do need to qualify for. However, it's for high deductible medical expenses. Those types of plans can be self-directed. Again, as I mentioned before, typically within a regular traditional IRA, you're investing in stocks, bonds, mutual funds, CDs, things that you're probably not happy with the return. And usually when you have a 401k, you're restricted by the plan documents that come along with that. Now, with a self-directed IRA, we open up the investment options. Real estate, mortgage notes, tax liens, precious metals, private stock, hedge funds. You can actually have a company. You invest in a company. You can have loans, unsecured or secured loans, all as an investment to your IRA. So let me give you a few that are favorites around the office. One person invests in personal seat licenses and season tickets to the New York Jets in their IRA. So basically how it would work is they would purchase the season tickets, they would sell them on eBay, StubHub, Craigslist, all of the above, and any return that they receive goes directly into their IRA, which is an allowable investment. One individual also owns teak and mahogany trees in Costa Rica within their retirement plan. So basically they own a 15-year contract, and the seeds to these trees, when they're fully grown, cut up, and sold into our furniture, that's when they get a return on their IRA investment. So people are doing crazy things within their IRA, but it's an investment, so it is allowable. There are restrictions. Obviously, there are certain things that you cannot invest in within a self-directed IRA. You cannot invest in life insurance. You cannot invest in collectibles. Collectibles, things like art, wine, stamps, my personal favorites, baseball cards. You cannot have that within your retirement plan. And you also cannot have dealings with disqualified persons. The list of disqualified persons are the IRA holder themselves, their spouse, any ascendants, any descendants and their spouses, any fiduciaries to the account are all disqualified. So what is disqualified? So say that person that owns the personal seat licenses and the season tickets to the New York Jets wanted to sell to one of these disqualified persons. They cannot. If I own a piece of property within my retirement plan, the IRA holder cannot live in it, the IRA holder's spouse cannot live in it, any ascendants, any descendants, any fiduciaries cannot live in that property. These people also cannot provide any service to this property. So if I wanted to go and mow the lawn on my own, on the house that my retirement plan owns, I cannot do that. Nor can any of the disqualified persons. So there are certain limits, and if you have any questions on any investments and just dealings with disqualified persons or prohibited transactions, you can certainly call the office. I love to hear what everyone's doing in terms of investments, so you could certainly give us a call on that. And why should you open a self-directed IRA? Well, a self-directed IRA, obviously, it has that broader selection of allowable investments. And what that does is that helps you create a diverse portfolio, a more eclectic portfolio that you can control. However, you need to realize that you are taking control of your investment. You do need to be in contact with Next Generation Trust Services and go over examples. Some people think that they're a pain, that they call up and they ask questions, but they're just covering their back. They don't want the tax burden that goes along with having their asset distributed to them, because there are penalties that can go along if you do something prohibited or disqualified. It's important that you're always in contact with Next Generation Trust Services, or that you have a trusted advisor that is knowledgeable in self-directed plans and ERISA law. And that's ERISA, that's retirement plan law, that's ERISA. Now I'm just going to leave my contact information here. You can contact us at info, that's INFO, at nextgenerationtrust.com. The phone number here at the office is 973-533-1880. Our website, www.nextgenerationtrust.com. Certainly would love to hear from you. I'll leave it open to questions right now, and I will also leave it open if you want to wait. You can listen to Denise's presentation and then ask your questions. But I'll leave a couple minutes if anyone wants to leave anything now. Again, my name is Jared Lopez. I'm a business development representative with Next Generation Trust Services. We're in Roseland, New Jersey. If you have any questions, certainly give me a call at that number here, 973-533-1880. Are there any questions at this time? So it doesn't look like we have any questions. Denise, how are you doing today?
Good. How are you?
Good, good. So I'm going to pass off the presentation to you, and I'm going to mute myself. If you need anything, I'll be here. You can just give me a shout, and the floor is yours.
Thank you, Jared, for that introduction, but I guess more importantly for inviting me to speak with your clients about an area of private investing that I personally, for one, find very exciting. So, hello, everyone. Thank you for being here today. And as Jared said, my name is Denise Yagodzinski. I'm founder and owner of Global Assets Group, Inc., and we are incorporated out of Florida. And what's most important to me, my business partners, is to build a business based on trust, building a reputation for doing what we say we're going to do, and generating results, not just for our investors, but obviously for ourselves as well. So once again, welcome. These are pretty exciting times, as you know. Most people look at the news, the papers, and they find it scary. Well, that's actually when we jump in and do our buying, because as you know, just like with the stock market, the contrarian investors are the ones that buy low and sell high. And what are we looking at today? Well, property values that are extremely low, we haven't seen in a long time. Interest rates are phenomenally low now. I can remember my first condo I bought in 1982. My interest rate was 10.5%, and that's with a credit score of 800. We've come a long way in the right direction since then. And, of course, there's plenty of supply. All you have to do is turn the corner and you're going to see a property for sale, whether it's residential, commercial, etc. So what do? We're a commercial and residential real estate acquisition company, but by far the lion's share of this presentation will address the commercial side of the business. And what we do there, because it's just such a great business model for partnering with people, you do need boots on the ground wherever you're buying properties, and we do buy across the United States. I'll get into that in a second. But it's a great business for partnering. But you need people, eyes and ears on the ground where you're investing so that you can always stay in control of those properties. So on the commercial side, it took us a while to find a partner like this, but we deal with somebody who's very reliable, trustworthy, buys large multifamily investment properties in Texas, currently at 1,500 units with about $45 million in assets, and that was achieved within the last 5 years or so. So the three objectives of today: what we invest in, obviously how we invest, and how we can get investors involved in secured investments. So on the commercial side of the business, this is what we buy: cash flowing and or appreciating investments. And what I mean by that is cash flowing obviously is an ideal situation where you walk into a property and it's generating cash from day one. And what you're looking to do there is build on that existing momentum. In terms of appreciating investments, what we look for is where we can add value to that property. And what I mean by that is finding the right owner. Maybe there is an out-of-state absentee landlord, a tired owner of taking people to eviction court, maybe an owner that's changing strategy, selling off to buy something else, or trading up. Obviously, today there are a lot of people that are facing foreclosure, so inherent in this is an opportunity, obviously. So, like I said, we like to do both, ideally, but sometimes we go into a property where there's such a great opportunity and it's short term, meaning we can do some micro repositioning. And that means spending about $700 to $1,000 a door. We do some sprucing up of the landscaping. And in about 18 months, we're able to refinance through traditional means, get our investors out of the investment and either sell the property at that stage or continue to hold if the cash flow is significant enough. And what we use basically to offset whatever we can't get through traditional investing and financing is qualified investors. And what I mean by that is qualified investors as defined by the SEC. Regulation D is the legislation that rules over this area of investing, and we follow the rules very, very strictly. There are two groups of qualified investors, accredited and sophisticated, and I'll get into that with you in a second. The other thing we do is market analysis, intense market analysis. We go to the Bureau of Labor Statistics, we go to local management, we go to economic development councils to find out where the best areas are to invest. And I'll get into that more in a second. But we acquire the company, we manage the company directly ourselves. In this business, the trickiest thing about commercial multifamily investing is that when it comes to property management on site, and if you're looking at an investment of over 50 units, you basically need somebody to do that on site. For 50 to 100, you're looking at part-time management. But anything over 100, you've got to have somebody on site. The problem is that there are not a lot of good property management companies out there. So if you're going to be making the investment in commercial multifamily, you need to pursue somebody ideally that's been there, done it, and is self-managing those properties, staying on top of the investment. And by the way, multifamily commercial is different than multifamily residential. Residential only goes up to 4 units. Commercial is defined as anything above 4 units. And where we invest is in emerging markets. And what I mean by that is markets where there's appreciation either from new growth or from correcting markets from a prior downturn. So what are the advantages of multifamily? Why do we do this? Well, there's historically more stability in those properties than in other real estate sectors. And of course, I'm referring to residential. When people lose their homes, where do they go? They go to rent. The multiple units under one roof significantly reduce the risk of negative cash flow, in addition to self-management, obviously, of the property. But there's also economy of scale. If you have one roof over 100 tenants, that's a lot more favorable than one roof over 1 tenant with a single family. In-house property management I've addressed, but what we look to do there is increase the value of that property every year based on improved operations. So whether it's low occupancy, low rent, changing the mix of the tenants, there's a lot of opportunity typically in the properties that we purchase to do those things. And what we like to do and take pride in is actually adding value to the community through quality living conditions. You know, a lot of these owners that are tired landlords, their properties are run down. So the physical appearance alone of the property in the neighborhood and community is a negative. So we add value there, but we also add value, obviously, to our investors through a solid stream of income. The more advantages, it's the opportunity to have direct financial participation in a performing asset. And we only come near properties where we are 120% certain that we're going to be able to do some good with value. Diversification among uncorrelated metro areas. So at any given point in time, different metro areas across the country are going to be in a slightly different stage of growth. So it's a way to diversify a portfolio very similarly, obviously, to being in the stock market. And it approximates a mix of fixed income because there's quarterly cash flow that comes in off these properties typically. like I said earlier, especially if we're cash flowing from day one. And the equity with stock-like appreciation comes into play when you've got value added from improving the operations of the property, in addition to what we do in emerging markets. So if you're in an emerging market, you're going to get a knock-on effect on your appreciation on the property. So what we see is consistent returns over time as demand is based upon population and income and in emerging markets, like I mentioned previously. So we're looking at a population of income about 25,000 to 32,000. That's our primary goal in looking for renters. And the population has to be at least 100,000. I'll get into that in a little bit more detail later. So you have to have enough people to draw from. So this combination of population and income obviously acts as a hedge against inflation with this investment. So I mentioned qualified investors earlier and how the SEC defines them as such. Accredited means on an income basis, people have to have a minimum net income of $200,000 in each of the last 2 years, or joint income with a spouse where the minimum is now $300,000 net income with reasonable expectations of staying in the immediate future. And the reason, by the way, that the SEC lays out all these definitions very strictly for us and counts on us adhering to them is because there is risk in any investment you have. So we want to make sure that any investors that get involved in any of our products are accredited or sophisticated. But the other definition of accredited is net worth. So individuals that have net worth that exceed $1 million, and of course the second piece of this definition was added since the downturn in the real estate market. This means disregardless of positive equity and personal residence. So that cannot be included in the $1 million. Sophisticated investors, they don't have to meet the net income or net worth definition, but they must be demonstrated in terms of their experience in investments, whether it be business or financial background. So what happens is when we look at getting investors involved in any of our products, there's an interview process. It's not extensive, but we need to make sure that what we are offering fits the investment criteria and the experience, the knowledge, et cetera, of the investor. So I referenced emerging market earlier. These are real estate markets across the country that have the potential to appreciate pretty rapidly over a 3 to 7 year period. What is more typical is 3 to 5 years, but because we approach this very conservatively, more than maybe most companies do, we look at a horizon of 7 years. Emerging markets, this is just a smattering of emerging markets. At any given point in time, this is going to change. And what I will say is that since this was produced back, I guess it was about a year ago now, Texas has really taken off. In fact, most of our investing is done in the Dallas-Fort Worth, Texas area. We've invested already in North Carolina and are looking into South Carolina. But there are many, many more emerging markets than shown here on the map. But this just shows you that if you really want to diversify your portfolio as a business, you have to spread out across the map. Why emerging markets? Well, you get higher than average returns there than you would in your other real estate markets that are not emerging. Initially, at least, there's not as much competition. What you find is that the competition for these products that we buy, the multifamily apartment buildings, they're mostly local investors initially. So as word gets out about the market and as more people come in with their businesses and add population to the area, then you get the national players, the national real estate investors that jump into the game. So if you get in early enough, you can close very quickly. It's easy to close fast on these properties, and you get much better prices, obviously. There's an opportunity in emerging markets to trade up faster, and that's just logical, right? If you buy a property for a couple of $1 million, are able to do some micro repositioning, that 18-month window that I talked about earlier, or even if you're holding a property for 2 or 3 years, If you're in an emerging market, you're going to see the advances in the equity and appreciation that much faster, which gets you out of that property that much faster and into the next, which is bigger. So when you go into your next property, if you're doing a 1031 exchange or some other tax-protected vehicle, you're not really spending more money, but you're getting more value. So the other advantage of emerging markets is it enables us to invest like the institutions. We're able to buy $10, $15 million multifamily apartment buildings through syndications, according to the SEC Regulation B. We're able to syndicate with a group of investors and invest like the big boys, like the hedge funds do. And also, for that matter, like the real estate investment trust do. I'm sure a lot of you are familiar with the REIT. They buy properties all over the United States because they go where the biggest returns are, right? So how do we look at emerging markets? What are the characteristics that define them? Well, year-to-year job growth, 2% is one thing we look at. We also, by the way, look at household growth of 2% minimum. We look at large populations. The bigger the population, obviously, the more tenant base we have to draw from. Ideally, we're going to see state capitals and college towns being very attractive in the emerging markets. And if you get a state capital that also happens to be a college town, you're looking at much, much greater returns. Of course, locally, what's important is that you have strong leadership in place. These people have to be able to make decisions, whether it's a mayor or governor. You know, as most people know, if for no other reason through the recent election process, Texas is a very business-friendly state. So the leadership there is strong. Not only do they make decisions, but they follow up with action on those decisions. And obviously an appealing lifestyle is very important when you're looking at the multifamily segment of real estate. Some more characteristics, we'd like to see airports within easy commuting distance. We don't need a hub, but a major carrier like United, JetBlue, Southwest, etc. would be ideal. The reason we like to see a lot of major interstates is for transportation of goods and services, to keep that area as vital as possible. We'd like to see big box retail, Lowe's, Super Walmart, etc., because people are going to be drawn to that area from the region. The same thing with health services, a hospital, a regional provider of health care, very important. The path of progress, well, that's kind of simple. It's where there's new construction or historically where there's been better properties getting higher rent. So we look for paths of progress. Revitalization zones, I'm sure a lot of you are familiar with that as well. It's areas where the city's putting their money. They're revitalizing it because it's been down for a while. And you see a lot of that as well. Market cycles, this is interesting because, you know, when the bubble burst in real estate started back in 2005 through some of the more states that were aggressively appreciating, like Florida and California, Arizona, these people in the media made it sound like this was a national. Now, granted, there's a lot of bad things happening on a national level, but real estate has always been a local market. And what happens is you find cities across the United States that are going to be in one of these cycles at any given point in time. So you see the four markets here on the screen, the four cycles. This is how they look on this curve. So from peak to peak or trough to trough is normally about a 20-year cycle. Between the buyer's market 1 and 2 is a 5-year cycle, give or take, okay? So where we like to buy is at the bottom of that curve, in the trough, okay? Actually, we start looking at an area right before that tick mark there, and we sell at the seller's market 1. I'll get into the definitions of these market cycles in a second. But we want to be in when companies decide that they are going to build a plant, okay? They're going to hire 1,000, 15,000, whatever the number is, X employees. So we get in there, try to buy a property so that we can rent to not only the construction workers that are going to be there for some period of time, but also for the new employees that come in. They're not sure exactly where they want to live. Maybe at the white-collar level, they can afford to buy a home, but maybe they just want to rent for a year to check out the area, see how the job goes. So we actually start looking slightly before where the buyer's market 2 tick line is, and look to get out, seller's market 1, so halfway up the curve. And the reason for that is this. In the buyer's market 1, you still have a market that is oversupplied, okay? You've got prices and rents that are starting to fall. The time that a property is on the market before it sells is increasing. It's just getting longer and longer. New construction starts to stagnate. Unemployment reaches a new height. And obviously foreclosures rise sharply. When you contrast this to the buyer's market 2, this is where now you see the market has absorbed a lot of the oversupply. Time on market decreases, so properties start moving faster. Job growth, like I mentioned before, is coming into the area. It's on the rise. Existing properties often get rehabbed during this period in the cycle, and rents and prices begin to slowly rise as well. In the seller's market, which is where we look to get out, you start to see the supply dwindling. Properties are selling fast. Time on the market is at its lowest. Typically you'll see maybe 30, 60 days on the market for the bigger properties. Property prices and rents are clearly rising. Demand is at its highest point. Now, who would jump into the market right here? Typically your speculators, okay? Your speculators jump in and they try to ride the entire curve. But at the seller's market too, the time on the market starts to increase a bit. The supply is increasing. Why? Because everybody that maybe thought about selling, they say, wow, the market's going crazy. We've never seen prices like this in the last 20-year cycle. Let's put the place on the market, see what happens. So sellers are waiting, but they're still getting inflated prices. The construction pipeline gets to be excessive here, and now you start to see business and job growth slowing down a bit. So that's the 4 cycles, and like I said, we buy at the buyer's market too and look to get out between 3 and 7 years. We also look at classes of properties when doing this kind of investment. The A properties are typically your luxury. They're in great areas. They're newer properties. They're 10 years old or newer. You've got B-class properties that are about 20 years old. Mostly you're going to find white-collar workers renting here, some blue-collar workers. C-class of properties, now you start to see maybe some marginal areas. The properties are a little bit older. They need more maintenance. And mostly these are blue-collar. Sorry about this little joke, but D-class properties, you don't see a lot of shirts, okay? These are your war zones. We do not go near them. How we invest, we perform a lot of market and property analysis. We present an LOI, which is backed up by an initial offer. We do our due diligence, which can sometimes take months, depending on the size of the property. We do not leave any stone unturned. We go through every inch of the property. We don't just look at sample apartments. We look at every apartment, all of the common areas, the grounds, etc. Full inspections, you name it, we do it. Then we negotiate, renegotiate, trade if we have to on the big items, and make our final offer. So what we're looking to invest in terms of class of properties is acquiring B or C properties, and I like to call it C+, but we look to get them in A, B areas, because there's another opportunity to upgrade the value of your property, okay? If you are buying a property that is in physical BC kind of condition, but you're in an upper area, 1 class higher or 2 classes higher, you really have the knock-on effect of equity. So what we do is we increase operational performance and value. I touched on this earlier. We try to increase occupancy, raise the rents as fast as we can. whatever the market will bear. We look to change the tenant profile, upgrade that, and do property upgrades, maintenance. And we're out within 3 to 7 years. Refinance or sell. Some of the measurements that we look at, when we are looking at properties and whether or not they are good for us, we look at cap rates. These are typically how these properties are analyzed. Cap rate is the rate at which income left over after expenses, which is your net operating income, repays your purchase price on an annual basis. So the formula looks like this: net operating income divided by price or value. An example, say that your net operating income is $800,000, your ask price for the property is $10 million. That's going to yield an 8% cap. Then what you need to do is figure out whether or not that is competitive for the area, and you speak to brokers and real estate management organizations, et cetera, for that. But you also want to make sure that that 8% is real, that the net operating income is real, and that's where the due diligence comes into play. We look for 3 years of trailing financials on these properties. We see receipts for the expenses. We don't leave any stone unturned. What are some of the typical cap rates by property class? And by the way, these are going to vary greatly by metropolitan area. But typically, we are in the B or the C class between 8 and 11%, especially in Texas. If you come into Manhattan, and we've looked at some properties there recently, there you're talking about a cap rate probably 5% on average. You're lucky if you can get something above that. And keep in mind that there is an inverse relationship between cap and price. So obviously, the higher the price, the lower the cap. Another measurement that we look at is cash-on-cash return. How much of our acquisition costs in total are recovered during the first year? So you take your net operating income, you subtract out your debt service, both annual amounts, and you divide by the out-of-pocket to buy that property. So in the example of $800,000 NOI, if your debt service for the first year is $500,000 and your acquisition costs are about 25% of a $10 million property, your cash-on-cash return would be 12%. Now I don't want everybody getting excited that this is what our investments yield. This is just one example of a cash-on-cash return. And the last thing we really look at is debt coverage ratio, which is obviously also what the lenders look at. How much does our net operating income cover our debt service? So the formula NOI is divided by debt service, very simple. You take your $800,000 NOI divided by your debt service, and it's a factor of 1.6. So from our perspective, obviously, if we're looking to get conventional, traditional financing through Fannie Mae, we're not going to be able to be below that because that is their threshold. How we fund our deals. Primary source of funding, as I mentioned, Fannie Mae. About 75–80% of our deals are funded that way. And then the secondary source is qualified investors. So what are our investment objectives? We look to preserve and protect our investors' capital investments at all costs. And if that means that the investors get a preferred return, doesn't matter how much money is in the deal, if we cannot pay our investors first, it's not a good deal for us and we'll walk away from it. Generate distributable cash to investors on a quarterly basis and then dispose of the property. And like I said, most of our dispositions occur within 3 to 7 years of acquisition date. So how do qualified investors benefit? Well, typically these are higher returns than you would see in IRAs, savings, CD accounts. There's passive cash flow. The investors just participate in conference calls, et cetera. I'll get into that in a second. There's equity buildup, just like you would have in a stock appreciation. No management responsibilities for the investors. They are secured investments, and the SEC rules are followed. In fact, we engage the services of SEC attorneys so that everything is buttoned up by the Regulation D. So how is it secured to the investor? Well, we've got operating LLCs. So the membership goes right into the operating LLC, either directly or through, like Jared was mentioning earlier, a self-directed IRA account. We also have the investors on property insurance, obviously, and title insurance. So the equity ownership position is in the form of a certificate of ownership. So you just stick that in your security box at the bank. Cash flow comes quarterly based on whatever your ownership percentage is in the deal, and appreciation comes upon refinance or sale, again based on ownership percentage. So the monthly executive summaries go out to all of our investors, but on a daily basis, when we first pick up the property, we are looking at a lot of factors to stay on top of our investment. Occupancy to date, occupancy forecasted, 30 to 60 days out, and we do this daily and weekly in the form of a Monday morning report. We look at the number of units that are made ready. That means the tenant has vacated and they've already been turned by maintenance, so they're ready and available for new tenants. We look at the number of empty units. We look at the number of work orders that have been produced that week and how many have actually been completed that week. We look at the traffic that comes into the property, people that come to see the property, and how many of them get closed, meaning how many of them sign a lease. And we expect a minimum of 30% closure. We also look at the amount of cash that gets collected that week versus what's outstanding. So there's a lot that gets rolled up into these executive summaries that investors get. In addition, we conduct quarterly teleconference calls where all the investors are on the line and they get to ask as many questions as they care to. But outside of that, obviously, they contact us anytime with any questions. And after that, it's simple cashing of checks. On the residential side of what we do, we rehab second-time home buyer properties. The reason they're second-time home buyer properties and not first is with the current lending environment, we see that as a little bit too risky right now, that the second-time home buyers, if they're trading up, they generally can qualify a lot more easily, and they know what they're looking for. We look for very desirable neighborhoods in northeastern New Jersey, which is the other state that my company operates out of. And these are neighborhoods where there's at least 3-star rating on school systems, easy transportation into Manhattan, etc. We purchase at a minimum of 50-60% discounts there. And the reason for that is we are looking to turn these properties in 6 months. So the holding period is much shorter, obviously, than the multifamily commercial properties. And I look to get into this business to turn in 6 months because I learned my lesson in Florida with residential properties, and it's going to be a long time before I buy something residential to hold unless the discounts are even deeper than this, okay? But I work with partners in Northeast New Jersey that are experts in this area. They rehab these properties to market, and they turn them in 6 months very successfully. So these are sole investor opportunities. They're not the SEC regulated or the larger syndicated deals. So there's a higher minimum investment front end. And the principal, once again, is secured through title to the property, title insurance, and property insurance, just like with commercial. The monthly progress reports are still sent out to investors. And we are always available, obviously, for questions. So I want to thank you for your time today. As Jared said, we open up this time now for questions. Again, my name is Denise Yagodzinski. I'm with Global Assets Group, Inc. as the founder and owner, and my website is www.globalassetsgroup.net. And my cell phone is 201-962-6802. in the event that you have questions that occur to you after the webinar closes out. And that's it. So thank you again for your attention. Thank you, Jared.
Thanks, Denise. That was very informative. Let's open it up for some questions. Anyone out there? I know we had one as you were going, so I'll give you that one first. I guess you covered it a little bit, but maybe you want to go into it a bit further. Where do self-directed IRAs fit in to your company and real estate investing as you were speaking?
Well, from what I understand in speaking with you, that these are areas where people can get the appreciation, all of the equity tax-free, depending on which of those vehicles that you mentioned earlier.
Correct. Tax-free, tax-deferred, or tax-free.
Exactly. So it's just a way to defer or avoid taxes completely. Otherwise, you're going to be hit, on some of these deals, we're talking about a $1 million profit. You get hit pretty heavily, obviously, unless you can do this kind of protection with a self-directed account.
Wonderful. The next question, what are your company goals going forward?
Well, we're looking to maintain our steady growth, but in the next 5 to 7 years, we are hoping to get about 10,000 units under our belt, because we're finding that as we work with brokers and lenders and investors, we're able to close on these properties a lot faster than we have been in the past 5 years. So that's our goal, to get 10,000 within the next 5 to 7 years.
And why northeastern New Jersey?
Well, that's an area that I'm most familiar with. I guess the market there I see as being one of the strongest. I mean, you could argue that Connecticut and areas of New York State would be similar in terms of a very easy commute into Manhattan. But these are areas where the school systems tend to be stronger even than those in Manhattan. And you find a lot of Wall Street people living and buying in these areas. So it's a very ripe market for these types of homes, where typically we'll buy a home for maybe $300,000 and put about $150,000 into it and make some nice back-end profits. I mean, I'm not supposed to talk about returns here, but the returns are pretty significant in this area.
All right, wonderful. We'll give another minute to see if any questions come in. So I think that'll do it for today. Denise, thank you so much for coming on board and discussing something that is a very popular topic, a very popular investment within self-directed IRAs. People tend to want to get on board. They just don't have the information, don't know where to begin. So I thank you for sharing that. I'll pop up my contact information as well. You can reach Denise at 201-962-6802. And if you have any questions about self-directed retirement plans, you can give us a call at 973-533-1880 or email info, that's info, at nextgenerationtrust.com. Thank you so much for attending, and keep an eye out for more webinars coming up soon. And if you have any questions, you can give me a call. My name is Jared Lopez. Thank you so much. Thanks, Denise.
Thank you.